If you bought gold above 5,000 or silver above 90, I'm not going to sit here and tell you everything is fine. It is not fine. Your money is down, maybe significantly. And that feeling in your stomach, that heaviness when you open your portfolio and see red everywhere, that is real. I know it. I feel it. And I'm not going to insult you by pretending it does not hurt. Gold went from 5,600 to 4,900. Silver went from 21 to 75, in some cases in days. These are not small numbers. And now every headline, every comment section, every financial guru is telling you the same thing. You were stupid. It was a bubble. You should have known better. Sell what is left before it gets worse. And that is exactly what I want to talk about today. Because I think those headlines, those gurus, those voices telling you to sell right now, I think they are wrong. And I think some of them know they are wrong. And I am going to show you why I believe that. But I am also going to be honest about the risks. Because anyone who tells you they know exactly where gold and silver are going next is lying to you. I do not know. Nobody knows. What I can do is show you what the data looks like right now and let you make your own decision. That is all this video is. Data context. In my honest opinion, take what is useful, leave the rest. Welcome to the hidden economy. If you are new here, hit subscribe. I have been covering this metal story for weeks, and I have not been wrong yet. That does not mean I will not be wrong eventually, but my track record is there for you to check. Every video is still up, and I want to tell you I have only one channel, which is the hidden economy. When silver was at $117 and everyone was celebrating and buying like nothing could go wrong, I made a video on this channel warning that a big crash could be coming. 117. I told you why the setup was dangerous, why the leverage was extreme, why the conditions were ripe for a violent pullback. People were calm, people were buying, nobody wanted to hear it. And then silver went from 121 to 64 in days. Exactly what I warned about. I'm not saying this to brag. I am saying this so you understand that when I tell you something today, I have earned the right to be heard. I was not one of the people cheering at the top. I was the one telling you to be careful. And now I'm telling you something different. I'm telling you this crash is an opportunity. So maybe hear me out. And if you are sitting there right now, scared, not sure what to do, not sure who to trust, then join my channel right now because this is what I do here. I break down gold and silver in a way that actually makes sense. No hype, no blind optimism, just data, context, and honest analysis. Every video I have made on this channel is still up for you to check. I hold silver, I hold gold, I hold mining stocks. This is not financial advice. This is me sharing what I am seeing and what I am doing with my own money. Now, let me tell you something. In 2008, gold crashed from over $1,000 to $680. 32% drop. Every headline said the same thing. Gold is done. Safe haven is dead. People sold. Within 3 years, gold was at 1,900. Think about what that feels like. Selling at 680 and watching it go to 1,900, then 2,000, then 3,000, then 5,000. You had it. You owned it. And you let someone scare you into giving it away. In 2020, at the start of COVID, silver crashed to $12. People panicked and sold. Within 18 months, silver was at 30. The people who held at 12 are sitting on 600% gains right now because they did not sell. And now here we are again. Gold dropped 21% from its peak. Silver dropped 41%. The worst single day for silver since 1980. The same voices are saying the same things they said in 2008 and 2020. It is over. Sell. Move on. I'm not saying history has to repeat. Maybe this time is different. Maybe the crash continues. Maybe gold goes to 4,000. Maybe silver goes to 50. I cannot rule that out. And anyone who does is not being honest with you. But what I can tell you is that the last 2 times, the world looked exactly like this. Selling was the worst decision you could make. And the reasons it was the worst decision then are the same reasons I think it might be the worst decision now. Let me show you what I mean. The first thing I want you to see is a chart that has nothing to do with gold or silver. It is a chart of the U.S. stock market going back 140 years, specifically something called the Shiller P/E ratio. Do not worry about the name. All it measures is how expensive stocks are relative to what companies actually earn. The higher the number, the more overpriced stocks are. Right now, that number is 40.58. In 140 years, it has only been higher than this twice. The first time was 1929. You know what happened next? The second time was 2000, right before the dot-com crash. Those are the only 2 times in your great-grandparents' lifetime that stocks were more expensive than they are today. Why does this matter for gold and silver? Because both times, after stocks crashed from those extreme levels, money flooded into gold. After the dot-com crash, gold went 7 times higher. After 2008, gold nearly tripled. The pattern is simple. When stocks are this expensive, something eventually gives. And when it gives, people rush to the thing that has held value for thousands of years. I'm not telling you the stock market is about to crash tomorrow. I'm telling you that the environment, the setup, the conditions, they are identical to the two worst periods for stocks in modern history. And in that environment, gold and silver have historically been the best place to be, not the worst. And here's what makes this personal. You're worried about gold dropping from 5,600 to 4,900. But are you equally worried about a stock market that is more expensive than it was before the Great Depression? One of those is a correction in a bull market. The other is a potential generational collapse. Ask yourself which one the media wants you focused on, and ask yourself why. The second thing I want you to see came out 3 days ago. Reuters, not some random blog. Reuters reported that Chinese regulators are telling their banks to reduce holdings of U.S. government bonds to limit new purchases to pare down positions. The reason concerns about U.S. creditworthiness. Let that land for a second. The second biggest economy on the planet does not trust American government debt anymore. And they are not hiding it. They are telling their banks to get out in public on the record. Where does that money go? When China sells billions in U.S. bonds, where does it end up? History tells us it goes into gold. China has been the biggest central bank gold buyer for years, and now they're accelerating. They're making it policy. While you and I are sitting here watching our gold portfolio go down and wondering if we made a mistake, China is actively moving its national reserves into the same asset class we own. Let that sit with you for a second. And this is not just about China. Trump's approach to trade, his pressure on the Federal Reserve, the tariff threats, all of it is making countries around the world nervous about holding U.S. assets. The Reuters article specifically mentions that market participants are questioning the haven status of U.S. debt. That is a quote, the haven status. When the world's safe haven asset starts losing its reputation, the replacement is not crypto. It is not stocks. It is gold. It has always been gold for 5,000 years. Now, let me show you something that genuinely changed how I think about money. Take gold priced in dollars and flip it. Instead of asking how many dollars does an ounce of gold cost, ask how much gold does $1 buy over the last 50 years? The dollar has lost 99% of its purchasing power against gold since 1970. There have been 4 brief rallies for the dollar against gold in 50 years. 4, each one weaker than the last. The chart looks like a staircase going into a basement, and the annotation says the target is 0. Is it going to 0 tomorrow? No. But the direction has not changed in 50 years. Not once. And every time the dollar has a good week and gold drops, people mistake a bounce on the staircase for a reversal of the trend. It never is. It has never been in 50 years. So when I see gold drop from 5,600 to 4,900 and people say the gold rally is over, I think about this chart. I think about 50 years of data showing the exact same pattern. Dollar rallies, gold drops, people panic, dollar fades. Gold goes higher. Repeat for half a century. Now, let me talk about gold. And I am going to tell you something about the crash that you will not hear on any other channel because everyone is focused on how far gold fell. Nobody's looking at how fast it bounced. And that bounce tells you everything. Gold was at 4,400 at the bottom of this crash. It has already bounced back to around 4,900. The shape it is making on the chart, without getting into technical jargon, looks like a coiled spring. It is compressing between a floor that keeps rising and a ceiling. These patterns typically resolve with a big move, and the math behind the pattern points to roughly 5,900 as a target. That also happens to line up with JP Morgan's year-end forecast of 6,300. Could it go lower first? Absolutely. If it does, I'm watching 4,500 as my buy zone. That is where the heaviest buying kicked in during this crash. Sovereign money, central banks, the kind of buyers who do not check their phone every 5 minutes, they were buying between 4,400 and 4,600. If gold comes back to that area, I think it is a gift. But here's what I find interesting. Gold hit 4,400 during the crash and bounced hard. It did not sit there. It did not slowly drift down to 4,000 or 3,500. It touched 4,400, and within days it was back above 4,900. That kind of bounce does not happen unless serious money is waiting at that level. Someone wanted that gold and they took it fast. That tells me 4,400 to 4,600 is real support. Not theoretical, proven. And I want to be clear. If gold breaks below 4,400 and stays there, the picture changes. That would concern me. I'm not married to any position. I'm watching the levels and reacting to what the market does, not what I want it to do. Blind loyalty to a position is how people lose money. I would rather be wrong and protect my capital than be stubborn and watch it disappear. But here's my bigger picture view on gold. I think gold is going to $6,500 to $7,000. In this cycle, the structural forces pushing gold higher, central bank buying, dollar debasement, the deficit, the geopolitical chaos, none of these are going away. They are getting stronger. If JP Morgan is calling for 6,300 by year end, the chart target is 5,900, then 6,500 to 7,000 in the next 12 to 24 months is logical. But your entry price matters enormously. Buying at 4,500 and riding it to 7,000 is a 55% gain. That is why I say wait for the pullback. Accumulating at the right levels, 4,000 to 4,500, is how you actually build wealth. Silver is personal for me. Watching it drop from 121 to 75 tests your conviction. But while the paper price collapsed, the physical market told a different story. London lease rates shot up to 4.5%. That means people with real money needed real metal. COMEX deliveries were massive. People were not selling physical silver, they were buying it. There is a disconnect. Paper says sell. Physical says hold and give me more. SLV had over $40 billion in trading volume in a single day, more than Apple and Amazon combined. That happens in a market that is being fought over. When there's a gap this wide, the physical market wins. If silver retests $50 to $60 and holds, that confirms a 50-year breakout. The market reprices everything above it. Reports say the Chinese government may be intervening in silver shorts. It has become geopolitical. Nations treat it like a strategic resource. Meanwhile, the U.S. deficit situation is not fixable. Every year the dollar loses value and gold becomes more necessary. China is still buying. The physical market is tight. Nothing fundamental has changed. The only thing that changed is the price. And if the thesis is the same, but the price is lower, that is not a disaster. That is a sale.